Hi everybody, welcome back. Today we are going to look at Chapter 10 in the OpenStax textbook, looking at international trade and capital flows. And so if you're following along with us as we progress, we went through international trade last week, talking about imports and exports, gains from trade, comparative advantage, all of that. This chapter is going to be a little bit more about concepts and terminology and just a smidge of mathematical modeling as we try to look at the other half of it. The idea that for every trade of goods and services, there's got to be a flow of money, of capital to compensate. We're going to talk about measuring trade balances historically and internationally and in general. We're going to talk about how trade balances are tied to the flow of financial capital. We're going to talk about national savings and investment, and we're going to do some mathematical identities to help us understand those and how they balance each other out. We'll talk about the pros and cons of trade deficits and trade surpluses, and the difference between the level of trade and the balance of trade. It's a pretty short chapter just in terms of content, slides, and reading, but it's kind of a dense concept, so make sure to take your time with it and let me know what questions you have. Keep an eye out for the terminology that's going to pop up. Like I said, the terminology is kind of a big deal in this chapter. We'll be talking about balance of trade, current account balance, export as a percentage of GDP, financial capital, and then different kinds of trade balance, and then that national savings and investment identity equation, which is going to be the little bit of math we do. So grab your slides, grab your textbook, grab your notes, and let's get started. Okay, so here we get into the chapter, International Trade and Capital Flows. And like I said, we're going to go through first looking at how we measure trade balances. We're going to look at them in a historical context and in the international context. And then we'll look at how trade balances are matched by flows of financial capital. We'll model this mathematically using the national savings and investment identity, which I think is actually a pretty straightforward way of looking at it. It helps make accounts look a little bit clearer. We'll talk about the pros and cons of trade deficits and surpluses, right? Should we be worried about these things? And then we'll talk about the difference between the level of trade and the trade balance. So all of this is talking about the idea of global money, global financial system, and how we interact with it. And you might not think you interact with the global financial system much, but anytime you're buying a good or a service from another country, you are engaging in that system inadvertently and sometimes indirectly. And so all of this really has an effect on us, right? When we import goods from another country, we usually have to buy them with their currency. And that's basically what we're going to be talking about today. So to do that, we want to talk about trade in a new way. We want to talk about the balance of trade or the trade balance. Either way, it's just the gap between exports and imports. And that's because it's very, very rare that a country imports exactly the same value of goods and services that it exports. Usually we're going to have countries export more than they import or import more than they export. Either way, that's going to be the balance of trade. A lot of countries, the United States included, are going to tend to see it be one-sided. So if you're a high-income country, you're going to tend to have a lot of imports of goods and a lot of exports of services. In the United States, goods comprise less than half of our total productivity, but services make up more than half of our productivity. And so what we're going to tend to see is we buy a lot of our consumption goods and our manufactured goods from other countries in the form of import. We can actually break down this balance of trade into a couple of different submeasures. The first is a bit of the more old-fashioned way of looking at it, and that's the merchandise trade balance. And that's looking at the balance of trade only with respect to physical goods. But the reality is that our economy, as it has developed over the last several decades, has become much more service intensive, especially in higher income countries. And so the current account balance is a broader measure of the balance of trade, and it's going to include goods and goods and services, as well as international flows of income and foreign aid. So for example, the IMF, the International Monetary Fund, will sometimes give loans to countries, and that will factor in too. We also want to think about the idea of what are called unilateral transfers. These are payments that the government, private charities, or individuals will make where they send money abroad as a donation, right? Rather than not without receiving any direct service or any direct good. And so that's just money being sent unilaterally without some kind of explicit compensation. And so what you can look at here, if we look at these two charts, we can look at the trade balances in the historical and the international context. So this first graph looks at the current account and merchandise trade balance in nominal dollars going from the 1960s up to the 2020s. And you want to remember, of course, nominal just means not adjusted for inflation. And so we can see here how they're fairly similar almost identical in the 60s, 70s, and in the 80s we see a little bit of gap. And then in the 90s and the 2000s, we see a big change in a decrease in the current account balance and the merchandise trade balance. And then in 2008, there's really a huge divide between the current account balance and the merchandise trade balance. And what that shows is growth in the service sector and the other components of the current account balance relative to the change in exporting and importing of goods. When we see the lines be above zero, it's going to mean that the United States is running a positive trade balance. When it's below zero, that means it's a negative trade balance. That means we are importing more than we're exporting. And that's been the story for a long time in the United States. So you can see here in the United States, we see the merchandise trade balance be quite negative, meaning we are importing a lot more than we are exporting in terms of goods. But for services, it's a little bit more balanced, although we see a big drop off there in 2020. We can also look at the second chart, which is the current account and merchandise trade balance as a percentage of GDP. So rather than looking at dollar bills, right, millions or billions in this case of dollars, we're just going to look at it as a percentage of our growth. And that's a nice way of normalizing it, just to get a good perspective on how much these exports and imports, this trade balance is changing relative to our overall economic growth. And if you feel like these charts are a little bit small, I agreed. So I added a couple of slides in here. Here you can see it much more close up. And you can see here the trade balance is actually pretty balanced in the 60s and the 70s. And then in the 80s, we start to see increase in our trade deficit, especially with respect to merchandise trade balance. That increases in the mid-80s, probably in part because of fluctuating oil prices. And then we see a huge increase in our imports or a decrease in our exports. We see a huge jump in that trade deficit in just raw billions of nominal dollars in the early 2000s, and then this gap emerged between the current account balance and the merchandise trade balance. You see a similar relationship when it's measured as a percentage of GDP. It's just normalized a little bit. It's reduced in scale because it's controlling for our economic growth at the time, including here in the 50s and 60s when our trade balance and our account balance and our trade balance were positive relative to GDP growth. So when we want to measure the size of an economy's globalization, we want to look at the export of goods and services as a percentage of GDP, because that's going to help us measure how much the global economy is contributing to their overall economic growth. So remember, when we talked about GDP, when we first looked at GDP, we remember that it is a measure of national productivity. So the GDP of a country is a measure of that country's ability to produce goods and services in a given period. When we look at exports and goods and services as a percentage of GDP, what we're looking at is how much of that productivity is driven by globalization, either imported goods or exported goods, right? And so remember, GDP, that identity, is going to include consumption goods, investment goods, government spending, and then net exports. And that's basically what we're talking about here. So now we want to get into trade balances and flows of capital. And when we talk about capital, we're specifically talking about financial capital. Financial capital is the international flow of money that facilitates trade and investment. So it's going to be a couple of different things. It's going to be countries buying goods and services from other countries, but it's also going to be countries investing in other countries, buying up their debt or investing in their companies. And there's a connection between the trade balances and the international flow of financial capital. It's so close that we tend to describe it as the balance of trade or the balance of payments. We see them as sort of being pairs or two sides of the same coin. Each category of the current account balance is going to have a corresponding flow of payments between the country and the rest of the world economy. And so you can kind of think about the balance of payments or the current account balance as being a ledger for a country's interaction with other companies in terms of finances and goods and services. And we'll look at this a couple of different ways. So one way we can look at this is by leveraging a sort of similar version to what we saw with our circular flow model. So here, instead of having the circular flow model with a household and firms, now we have a home country and the rest of the world. And we see the flow of goods and services and financial capital between these two entities. So our home country is going to derive imports from other countries and give payment for those imports. They're also going to export goods and services to the rest of the world and receive payments for those exports. On the bottom half, we see foreign investment. Our home country is going to send dollar bills to invest in the businesses and entities in other countries and then get a return on that investment received. In the exact same way, we are going to receive investment from abroad, from other countries buying our debt and investing in our companies, and then they're going to get investment income paid to them. And so the idea is that both, if we divide the world into a country and the rest of the world, we're going to see the flow of goods and services and payment for those goods and services go back and forth. And we're going to see the flow of investment and investment income in reciprocity flow back and forth. And so the idea here is that money and goods and services and forms of income and investment income are going to continue to flow back and forth between them in a constant cycle as part of a well-functioning global economy. Okay? So this brings us to this idea of the balance of trade being equivalent to the balance of payments. So if we talk about the current account, a current account deficit means that the country is a net borrower. So that means that they are borrowing a lot of investment money from other countries, more than they are investing in other countries. On the other hand, if they have a positive current account balance or a current account surplus, that means they are a net lender to the rest of the world. They are investing in other countries and receiving a lot of that investment money. The inflow and the outflow of foreign capital does not necessarily mean we're talking about government debt, although government debt is part of the picture. So for example, if you hear, and we'll talk about this more as we move on, the United States running a budget deficit, that means that we have government debt that's bought up by other countries. The two countries that are the biggest consumers of US debt are China and Japan. And so when we talk about our current account, part of that is going to be government debt that's owned by and pays investment income to China and Japan. But that's not the whole story. There are also other countries that are invested in US businesses and in the private sector, and that plays a part of it. So these international financial capital flows are going to include financial investors, private investors investing in other countries by buying real estate, buying companies, or just buying traditional investment instruments like stocks and bonds in the same way that you or I would, right? So maybe someone in another country is investing in Apple stock or Google stock or something like that, or buying up real estate as an investment property. That also factors into the balance of payments. Okay? And so it's this idea of just in the same way that we would want to keep track of all the goods and services being exported and imported, and all the money that's being exchanged for those exports and imports, we also want to track all of the money that is being loaned and invested between countries. And that's going to build into that balance of payments, that current account balance, whether it's positive or negative. So, how can we model this as simply as possible? We're going to use this national savings and investment identity to help us model it. And what it's trying to do is just give us a measure of the total private savings and public savings associated with the country. And this is going to become useful because we are eventually going to graph stuff based on this. But for now, we're just going to try and keep it really, really simple. And so we have an equation here, and each letter in the equation stands for a thing. So we have the idea that the supply of financial capital should, in equilibrium, be equal to the demand for financial capital. And that should make sense, right? It's just like any other market. We're going to expect an equilibrium where supply is equal to demand. And so we have to create the supply and demand and equate them for our purposes. So what we're going to say is that on the supply side, we have savings by individuals and firms in a given country, a market for savings, that's S. And then we're going to add to our savings our net exports, which is just imports minus exports. And we're going to say that that's equal to the demand for financial capital. So financial capital is supplied by savings, you putting money in your savings account, firms putting money in their savings accounts, people storing money in banks. But it's also going to be fulfilled by the idea that we have either a trade deficit or a trade surplus in terms of our interaction with other countries. We're going to equate that to our demand for financial capital. And who's demanding financial capital? Well, lots of people. But what we're going to talk about is private sector investment. And that just means firms and individuals and companies and entities trying to borrow money. And so we're going to call that I. And so we can see I, investment demand, being equal to S, savings, financial supply. But we're going to add to that our government deficit. And so our budget deficit is going to be our government spending minus our taxes collected. And the way you want to think about that is the government has a budget too. And the government budget or the government deficit is going to be equal to their income and their spending. So government spending is going to be how much money we spend on the military, schools, roads, whatever the government needs to buy, minus their income, which is going to be in the form of taxes. And lately, the United States tends to run a budget deficit. And so it's going to tend to be a budget deficit because government spending is going to exceed our tax collection. And we'll talk more about this and what the implications are for our country. So if we put this together and we look at this a little more closely, we see just what I said, right? If government spending is greater than taxes, then that means we're running a budget deficit. We're going to be demanding financial capital. That means we're going to need capital inflows, money to be coming into the United States, buying our debt. Like I said, countries like China and Japan buying our debt. On the other hand, if we had a budget surplus and taxes were greater than government spending, then we would have extra money. We'd be making more in tax revenue than we were spending in government expenditure, and that would mean that we would be supplying financial capital to the market. We would have extra money that we would say, hey, we're not just going to let it sit here. We can go out and invest in another country's debt or in somebody else's business, and that would be productive too. And so the idea here is that what we're really looking at is our trade balance, right? Or our trade deficit, trade balance, and our government budget balance. Here. And these things are going to be equated by savings, or the supply of financial capital, and investment. Okay? So there's a connection here between domestic savings and investment, and it helps us understand how the balance of trade is actually a macroeconomic problem. And what we're going to do here is we're going to move things around to help people understand, to help us understand how these things are interconnected. Okay? So what we're going to do is go ahead and walk this out. And all we're doing is moving things around, because what we're trying to do is make the connection between how private savings is connected to investment and our trade deficit. Imports minus exports equals investment and our government spending minus taxes. And so what we're going to do is we're going to isolate our trade deficit and subtract private savings from both sides. So we're going to get M minus X equals I minus S plus G minus T. Okay? And so what we see here is that if we're running a trade deficit, if our imports are less than our exports, then we're going to necessarily need we're going to need capital inflows to cover for it, right? So in the case of a trade deficit, we write it like this, and we can switch these around because the reality is we're just comparing our income to our expenditure, right? And so if our domestic investment is exceeding our domestic savings, that means we've got to be getting money from somewhere, right? If there's more investment than there is savings, then where's all that investment dollars coming from? It's coming from other countries. It's coming from capital inflows, money coming from other countries. Does that make sense? It comes back to this idea that savings is the supply of financial capital, and investment is the demand for it. And so if we're going to have domestic investment be greater than domestic savings, then we're going to need additional savings, additional supply of financial capital coming from somewhere. And that's going to be coming from the global community, right? That's going to be coming from abroad. The other case we can look at is in the case of a trade surplus. If we actually are exporting more than we're importing, we're going to have a trade surplus. And so what we'll have then instead is going to be our trade surplus. That ran away from me. It's going to be X minus M, or a trade surplus, is going to be equal to our private domestic savings plus some public savings, meaning there's some kind of budget surplus. Our taxes are greater than our government savings or our government spending, minus domestic investment. In this case, if savings, both public savings and private savings, public savings being the government having a budget surplus, private savings being firms and individuals keeping their money in bank accounts, if those are higher than domestic investment, then that means that other countries must be investing too. There might be extra financial capital being invested in other firms, in other countries buying up other countries' debt, that kind of idea. So we keep running through these examples because I'm trying to show how with this identity, as we move things around, there's got to be flows of capital either going in or out to create the balance. And that's really what we're talking about here. So you can think about it another way. Here you can look at domestic investment minus private domestic savings minus public domestic savings. So remembering that public savings is government surplus, and private savings is household savings. So if we have investment minus savings minus public savings is equal to a trade deficit where imports are less than exports, then as we change these things, we're going to see something else have to compensate, right? In this case, the national savings identity helps us see how things would change. So if we increase domestic investment, we're going to see that something else has to change. Probably our net exports will change if these stay the same. On the other hand, if domestic investments stay the same, then and we see private savings increase, then we're going to have to see our net exports decrease, okay? If one part changes, something else has to change too to compensate so that it can stay balanced. So it's either going to be the flow of money in and out of the country, our budget deficit, or our trade deficit, okay? So what does this all have to do with our economy? In the short run, whether our economy is in a recession or not can affect trade imbalances, right? When we're in a recession, we're going to consume fewer goods. We might see imports fall. A recession will tend to make our trade deficit smaller or our trade surplus larger, just because we'll be consuming less and we'll be trying to sell more to outside markets. On the other hand, when we're experiencing a period of strong economic growth, we tend to see larger trade deficits or smaller trade surpluses. This is not a given necessarily, but it's just a trend we tend to see. And it's going to be driven by how strong the economy is, what consumers are doing, and what firms are doing. Remember, when economies are strong, consumers are buying lots of things, firms are investing and growing and buying things as well, and that's going to generate a lot of economic activity. It's going to tend to generally mean that we're going to want more stuff from other countries. For some countries, for countries in general, there's not a lot of value to not participating in the global financial capital market. We see a lot of benefit from the ability to borrow and lend and invest in other countries. It makes economic sense as long as it's done correctly, right? There's income from investments and there's the benefit of getting capital from other resources. And so it's not really whether or not it's good or bad to invest in international or global financial markets. It's just about which individual investments you're making. That's what's more important. We'll tend to see that a nation's economy will grow through a period of global international investment. And there's examples from the United States. And when we look at countries that have recently experienced a lot of economic growth, like South Korea in the 1970s, we can look at how international investment and capital flows really played a strong role in that. A nation borrowing from other countries can find itself in trouble if it doesn't do a good job investing in productivity, though. And that comes down to that same idea, right? It's not about the global financial market being good or bad. It's about what you do with it, making good investments, investing the income in good places, and those ideas. You want to make sure that you're always investing in growth rather than sort of spending money. And it's nice because even though these macroeconomic concepts are really talking about larger ideas, there are sort of applications we can use in our everyday life, right? If I take out a small business loan and then use it to go to Disneyland, it's not the loan's fault, it was my choice. As a country, if I am engaging in a lot of international financial capital exchanges and I'm getting a lot of investment dollars or a lot of income from my investment in other countries, I want to make sure I'm doing it in a productive way that's going to grow my economy down the road. Okay? And really the whole point of this small section is to just get away from the idea that there's a problem with trade deficits or trade surpluses. Neither in and of themselves is a bad thing. The only issue is if it's being done for a bad reason or being done in an unsustainable way. So if a country runs a large trade deficit, it can be a sign of an economic problem or a problem with their fundamentals of their economy, or it could be a sign of their success. The United States has run massive trade deficits for a long time now, but so long as we can afford it and we're doing good things with the goods and services we're exchanging and the investment dollars that are coming in, then it should be fine. In the same way that a trade surplus isn't necessarily a good or bad thing either, as long as the exchange of financial capital is being used appropriately and there's a long-term plan for the success of the country. And so, especially if you're in an election season and people are talking about our trade deficit like it's a bad thing, or a trade surplus like it's a bad thing, these things aren't inherently bad. They could be great signs of success for an economy. It just depends on the fundamentals and how the income, the financial capital, is being used. The last thing we want to do here is separate out the difference between the level of trade and the balance of trade. The level of trade is just how much a country is exporting, usually as a percentage of GDP. The balance of trade, on the other hand, is going to be the exports and imports, right? Imports minus exports, looking at the relationship between exchange with other countries. There's going to be a lot of different things that affect level of trade and balance of trade. It's going to depend on the size of the economy, its geographic location, how easy is it to trade with other countries, and also its history. We see a lot of trade happen between countries that have had a long history of exchange and of diplomacy. It's just easier to trade with your countries you get along with. On the other hand, we can also see trade be used as a tool of diplomacy, right? I'll cut off trade with you if you don't do what I want you to do. I will trade with you if you continue to do what I like. I didn't like what you did. Do you want me to cut off trade with you, right? It is a mechanism for that. But generally, we see countries with a long history of diplomacy, thinking about the European Union, the United States. There's a lot of exchange there because of that history, regardless of size. The bigger the economy, the more likely they're going to be able to engage in exchange. But if you have a diverse economy like the United States, we see that we don't actually have that large a level of trade for our economy relative to other countries, because we're able to produce so much of what we want domestically. And we have such a large economy that trade isn't actually that big of a component. So think about these other countries and think about what you think about the level of trade they have, their balance of trade, and what the textbook says. Think about Sweden, the United States, and Japan. How are they different? How are they similar? And how do things like their size, geography, and history affect their level of trade in general and in specific? So, overall, trade deficits can be good or bad. It depends. Trade surpluses also can be good or bad. It depends on the underlying reasons why we see them. Even if the trade balance is zero, which means they're neither a borrower or a lender, it can be a good sign or a bad sign. In a lot of ways, having a lot of integration in the global economy ties all of our fates together and can be a really productive thing. And so a low level of trade or a low trade balance of zero might not necessarily be a good sign, or it could be fine. The fundamental question that economists want to ask is not whether a nation's economy is borrowing or lending, but whether the borrowing or the lending makes good economic sense for that country in that situation. And so it's actually, like a lot of things, a lot more complicated than just saying this is bad or this is good. So now that things are nice and complicated, we can wrap this chapter up. Okay, that's it. Again, this chapter is a little bit complicated, but it's also short. The big ideas here are trade balance is connected to a current account balance. The idea that exchange of goods and services is going to be partnered with and balanced out by exchange of capital. Excuse me. And so we want to measure those things together. The idea that we have private domestic savings and investment coming from our firms, and we have private savings and public savings coming from households and the government. And then those are going to interact with a global economy that also has investment and savings. And we're going to see flows of capital and flows of goods and services being returned between a given country and its market. This is going to help us get a much better sense of how global economies work and how we can look at the macroeconomy. The other thing we want to remember is that trade balances are different from trade levels, and they're neither good nor bad. It's always going to depend on the fundamentals of the economy. That's it. Let me know what questions you have, and I'll see you next time.